The US stock market has been a roller coaster over the last few trading days, big declines in the first week of August, and then a more than 3% drop on Monday. The VIX Volatility Index reached 55 at market open, the highest level since March of 2020, and before that since the 2008 global financial crisis. So I just wanted to make a quick video going through and explaining everything that's happening, including new data from the Bureau of Labor Statistics that sparked fresh recession fears, Warren Buffett dumping nearly $100 billion of stock, and how Japan is causing billions of dollars to flow out of the US stock market. So let's first start with what kicked all of this off. Last week, the Bureau of Labor Statistics released their July 2024 jobs report. It showed that the US economy had added just 114,000 jobs in July, and that's a considerable slowdown from recent months. In June, 179,000 jobs were added, and in May, 216,000. This of course also meant that the unemployment rate increased, reaching 4.3% in July compared to 4.1% in June, and the highest level since October 2021. What this shows us is that the interest rate hikes done by the Fed so far are having a slowdown effect on the economy. And this report in particular sparked fresh fears that the US may be heading towards a recession. Historically, when the Fed has raised interest rates to combat inflation, it's resulted in a recession. There's a very large lag between the Fed raising interest rates and the ultimate effect on the economy, so it's just really hard for the Fed to judge it correctly and to get it perfectly right. So far, the Fed has raised interest rates enough to bring inflation down without inducing a recession. So, of course, it's entirely possible that this time in particular, they've just nailed it, but more likely than not, history shows us that there's likely going to be some negative ripple effects. At the most recent FOMC meeting, the Fed voted to keep interest rates at the current range of 5.25% to 5.5%. Chairman of the Fed, Jerome Powell, said that the labor market is normalizing and inflation has eased substantially, and that the time is approaching for a rate cut. Again, historically, the Fed usually starts cutting rates before a recession actually occurs. And this is because, again, there's generally a considerable lag between the Fed's policy actions and the ultimate effect on the economy. Or, in other words, by the time the Fed starts to cut rates to help the economy, it's usually too late. The S&P 500 fell almost 2% on the Friday after the jobs report was released, bringing the market down almost 6% from all-time highs. The second big catalyst impacting the markets at the moment happened over last weekend while the markets were closed. Warren Buffett's company, Berkshire Hathaway, released their quarterly earnings report, and it showed that the company had $235 billion in short-term treasury bills, $81.2 billion more than the previous quarter. It also showed Buffett's stock portfolio had decreased from $336 billion to just $285 billion. And once you take into consideration the gains that the portfolio had during that period, it essentially shows that Buffett sold about $75 billion of stock in a single quarter over 3 months. And the vast majority of that was a single stock that he was selling, and that was Apple. Buffett had started selling Apple stock in the first quarter already, but this was a big step up, dumping over $50 billion of stock, bringing his investment down to just $84 billion. Just $84 billion. At the Berkshire Hathaway shareholder meeting in May, Buffett said he was selling Apple to benefit from the current 21% corporate tax rate. He has huge unrealized capital gains in Apple, which he mostly acquired in 2016. The current 21% corporate tax rate is a historic low for the United States, and Buffett thinks that it's a reasonable possibility that it goes up in the near future. Also, the stock has just become increasingly expensive over the last 8 years since he made the initial investment. So he seems to think that at least some of the money that he had in Apple stock is better sitting in treasury bills, earning a 5% return. Shockingly, Berkshire Hathaway has so much money in treasuries that they actually hold more than the Federal Reserve. For Warren Buffett and his company Berkshire Hathaway, they have more cash than they've ever had before to capitalize on opportunities if there is a market crash. And if there isn't, he's still able to collect a reasonable return on that cash, about 5%, while it's sitting in treasury bills. Despite the enormous cash pile, Buffett still has most of the Berkshire assets invested in stocks and businesses. And at the meeting, he said he still expects Apple to be his biggest investment for the foreseeable future. There's no doubt that Buffett's selling had a negative impact on the stock market come Monday. The S&P fell 3.6% on the open and finished down more than 3%. But Buffett wasn't the main culprit. It was actually Japan. While the US central bank over the last couple of years has been raising interest rates to fight inflation, Japan has kept their interest rates at between 0 and 0.1%. Japan has not had the same inflation problem that the US and, say, Australia has had in the last couple of years. In fact, they've had quite the opposite problem where they've been able to or needed to keep interest rates at rock bottom in order to ignite economic growth. But interestingly, the difference in monetary policy between the two countries has created the opportunity for a particular type of trade called the yen carry trade. This is where the investor borrows money in yen at very low interest rates, converts the money from yen into US dollars, and invests in bonds to earn a higher interest rate. The trade has also worked really well because the yen has been weakening against the dollar for quite some time, which means the borrowed money gets easier to pay back. But there is a big risk, and the risk is that if interest rates move in the opposite direction, things can get really ugly really quickly. And that's exactly what has happened. The Bank of Japan, their central bank, raised their interest rate from 0.1% to 0.25% on the 31st of July. At the same time, we now have a US central bank indicating that rate cuts are likely around the corner. So with the expectation now being higher Japanese rates and lower US rates, the yen has become a lot stronger relative to the US dollar. Just as a side note, for those wondering why a currency gets stronger or weaker in relation to interest rates, essentially if a country increases their interest rates or essentially increases the yield you can earn if you're buying their government bonds, for example, or really any assets in that country, then it's going to mean more money from foreign countries is going to flow into that country to benefit or earn those returns, earn those yields, and more demand for the currency makes it stronger relative to other currencies. So the yen has become a lot stronger compared to the dollar in the last couple of weeks, which is bad news for US investors who borrowed money in Japan. When those investors convert their US dollars back into yen, they'll have less yen than when they borrowed it, and so they'll need to come up with more money to cover that gap. And that's exactly what happened on Monday. We saw huge amounts of stock sales as investors tried to free up cash to close their yen carry trades. So what does this mean for you as an investor? Well, not a lot. Most people out there are probably investing over the long term through ETFs and index funds and that sort of thing. And if that's you, then this changes nothing. You should have a long-term strategy where you're consistently investing in the markets, only putting away money that you're willing to forego over many years. If you're putting away money that you need in the next couple of years, then you're at risk of being exposed to these kinds of volatile moves. But if you're investing over the very long term, it means absolutely nothing. In fact, the one way that it affects you is not in a negative way. If prices go down in the short term and you have a plan for consistently investing broadly into the US market, for example, then this volatility just means that prices are lower. So if you're a very long-term investor, it's kind of the same as if you're going to be a net buyer of anything. You want to see prices lower. You would prefer to see the price of fuel to be lower. And that's because you're going to be a net buyer of fuel, unless you're an oil mogul, I guess. But for most people out there, you're a buyer of fuel. And so you would prefer to see the price go down. And that is the same for if you're a long-term investor. You're going to be a net buyer of assets or net buyer of stocks over the foreseeable future. Somewhere down the line, you'll be a seller. But for right now, you would actually prefer if prices are lower. And even if you're buying individual stocks, the same thing is true. Hopefully, you're only investing in companies that are really high-quality businesses that you deeply understand and you have an idea of where they're going in the future. If there is volatility in the short term, it just increases the number of opportunities for you to invest money in great companies at reasonable prices. But it's also just very important to remember that nobody knows what's going to happen in the short term, at the very least. I made a video recently talking about recession indicators, And one of the biggest criticisms on that video and other similar videos I've done is that I'm making a prediction about that a recession is coming. And that couldn't be further from the truth. I have no idea what's going to happen with the US, whether they're going to go into recession this year or the next year. And the reason for that is that if you're going to make broad macro predictions, you need to be able to predict timing. And that's not something I think you can predict. I just find it personally interesting to observe these changes and observe these indicators and to watch them. They have no impact on my investing approach. I just think it's interesting to see what's happening, but that's also really important to remember that there is nobody who can predict when a recession is going to happen, and it doesn't really matter. Generally these days on the channel, I try and keep my opinion about investment strategy and that sort of thing out of the videos, because I think that what strategy works for you is going to be quite personal, and it's something you should discuss with a professional advisor. I don't think that's something you can glean from a YouTube video. So I generally just generally these days talk about what's happening without kind of pushing too much of what I'm personally doing with my portfolio. So I think that's just an important thing that maybe I haven't said on the channel in a little while. Subscribe if you enjoyed the video. It's free and it really helps me out. And consider checking out some of these videos next.